Wednesday breakdown. Nobody is talking about what Kevin Warsh is actually going to say tomorrow. Right now, most investors are watching the Fed and asking one question: are they cutting rates or not? But that's the wrong question, and the fact that 99% of the financial media is focused on that question is exactly why most investors are going to be caught completely off guard by what happens next. Because today, Wednesday, June 17th, 2026, something is about to change at the Federal Reserve. Not the rate. That's already settled. Everyone knows it's a hold. What's about to change is something far deeper, far more dangerous, and for precious metals investors, potentially far more important. Stay with me, because by the end of this video, you're going to understand something that most Wall Street analysts are dancing around, but won't say directly. Let me tell you what today is really about. Kevin Warsh just stepped into the most powerful financial office in the world less than a month ago. He was sworn in on May 22nd, 2026. And today, right now, as you're watching this, he is sitting in his first FOMC meeting as Federal Reserve Chair. At 2 p.m. Eastern today, the rate decision drops. Hold, everyone already knows that. But at 2:30 p.m. Eastern, Kevin Warsh steps to the microphone for his very first press conference as Fed Chair. And that press conference could quietly begin the dismantling of the entire framework that has guided markets for over a decade. Not gradually, not gently, potentially all at once. And nobody is talking about what that actually means for gold, for silver, for real assets, for your purchasing power. Let's break this down. Who is Kevin Warsh, and why this matters more than a rate decision? Most people think of Fed meetings in simple terms. Cut rates, market goes up. Raise rates, market goes down. Hold rates, nothing happens. That's the surface level. That's what CNBC focuses on. That's what gets clicks. But sophisticated investors know the truth. The rate itself is almost never the most important variable. What matters far more is the framework the Fed uses to communicate its intentions. And Kevin Warsh just walked into the building ready to burn that framework down. Here's who Kevin Warsh is, because this is important. He was a Fed governor during the 2008 financial crisis. He watched the entire system nearly collapse from the inside. He was the youngest governor at the time. He left in 2011, and for 15 years he watched from the outside as the Fed ballooned its balance sheet, invented forward guidance, published dot plots, gave press conferences after every single meeting, and essentially turned the central bank into a giant market management machine. And he hated it. He spent years writing papers, giving speeches, criticizing the Fed's addiction to communication. He argued that the more the Fed talked, the more markets became dependent on the Fed's words rather than actual economic conditions. And on January 30th, 2026, Donald Trump nominated him to take over. He was confirmed by the Senate 54-45, the most partisan confirmation of a Federal Reserve Chair in American history. He was sworn in May 22nd. And today is his first day actually running the meeting. The thing nobody is talking about. Here's where it gets interesting. The financial media is obsessed with the dot plot today. The dot plot is the Fed's quarterly projection chart. Each Fed official places a dot showing where they think rates should be at the end of the year. It's a roadmap. It's forward guidance in visual form. Markets have been addicted to this chart for years. And here's what the financial media is reporting. The dot plot is expected to remove its last projected rate cut for 2026. The so-called easing dot, the last signal that rate cuts are coming, is expected to disappear. That's significant. That tells you the Fed's easing cycle is formally over, even if they haven't raised rates yet. But here's what nobody is talking about. Kevin Warsh publicly stated during his Senate confirmation hearings that he does not believe in forward guidance. Read that again. The incoming chair of the Federal Reserve does not believe in forward guidance. And Wall Street analysts are now widely expecting that Warsh will withhold his own dot from the June projection entirely. He won't even submit a dot. Think about what that means. The whole premise of the dot plot, the Fed's most powerful communication tool, is that every voting member tells you where they think rates are going. And the new chair is walking into his first meeting and opting out. He's not just changing the rate. He's beginning to dismantle the communication architecture that markets have depended on for over a decade. That is not a small thing. That is a regime change. What a regime change at the Fed actually means. Let's slow down here and think about this carefully, because this is where most retail investors completely miss the plot. For the past 15 years, the Federal Reserve has essentially made a promise to markets. Not legally, not formally, but functionally. The promise went like this. We will tell you what we're going to do before we do it. We will publish projections. We will hold press conferences. We will guide you. We will be transparent. We will reduce uncertainty. And markets built entire trading strategies around that promise. Bond traders positioned around the dot plot. Equity traders priced in rate cuts months in advance. Hedge funds built models around Fed communication cadence. The whole financial system became deeply calibrated to the Fed's communication regime. And now Warsh wants to change that. He said he wants to emulate Alan Greenspan. Think about that for a moment. Alan Greenspan, the Fed chair who was famous for being deliberately opaque, who once said, and I'm paraphrasing, that if you understood what he said, he must have misspoken. Warsh wants to move toward less frequent press conferences, less forward guidance, more data dependence, more uncertainty. Here's the critical insight. If the Fed becomes less predictable, markets have to carry more risk premium. And when markets carry more risk premium, real assets, physical assets, tend to benefit. Because when the uncertainty anchor is removed, people look for a different anchor. And for thousands of years, that anchor has been gold and silver. The inflation problem. Warsh is walking into. Now let's add the economic context, because this is not happening in a vacuum. Inflation in the United States came in at 4.2% in May 2026. That's the highest reading since April 2023. The Fed's target is 2%. They're more than double their own target. And here's the part that rarely gets discussed. Energy prices are rising because of the ongoing conflict with Iran. Geopolitical supply shocks don't respond to interest rate policy. You can't cut your way out of an oil shock. You can't talk inflation down when the supply side is broken. So Warsh is stepping into a situation where inflation is running hot. Energy is a wild card. The Fed is already on hold. Trump is publicly calling for rate cuts. And some FOMC members are quietly projecting rate hikes. That's not a simple environment. That's a pressure cooker. And Bank of America just flagged something that should get your attention. At least 3 FOMC voting members may be projecting rate hikes for 2026. Not cuts, hikes. Meanwhile, there's a 42% probability priced into futures markets of at least one rate hike by the end of the year. 42%. Less than 6 months ago, the conversation was about how many times they were going to cut. This is how fast the narrative can flip. The gold signal everyone is missing. Now here's where I want to bring this home for precious metals investors. Gold is currently trading above $4,300 an ounce as Warsh walks into this press conference. Think about that number for a moment. A year ago, $4,300 gold would have sounded like a fever dream. Today it's the floor. Why? Because gold doesn't just respond to rate cuts. That's the oversimplification the mainstream financial media has sold for decades. Gold responds to real rates, the difference between nominal interest rates and inflation. When inflation runs above the interest rate you're earning, your money is losing purchasing power in real terms. And gold has historically been the asset that preserves that purchasing power. With inflation at 4.2% and the Fed funds rate sitting between 3.5% and 3.75%, real rates are negative in practical terms. Your money in a savings account is being eroded right now, in real time. But here's the deeper signal. If Warsh moves toward less communication, less forward guidance, more uncertainty, if he turns the Federal Reserve from a talking machine back into a quiet institution that moves when it moves and says very little in between, the uncertainty premium in the market goes up. And when uncertainty goes up, gold goes up with it. This isn't speculation. This is historically consistent behavior going back centuries. Central bank credibility crises, communication breakdowns, regime transitions, they all historically correlate with precious metals' strength. The silver angle. Now let's talk about silver, because if gold is the monetary metal, silver is the one that tends to move with more volatility, more force, and more upside when the macro stars align. Silver right now is caught between two powerful forces pulling in opposite directions. On one side, you have the monetary argument, same as gold, but amplified. If real rates stay negative, if the dollar loses credibility, if the Fed's communication framework gets dismantled and uncertainty rises, silver benefits as a monetary hedge, just like gold. On the other side, you have the industrial demand story, AI infrastructure, green energy, solar panels, electric vehicles, all of which require silver in quantities that are straining existing supply chains. The gold-silver ratio is still historically wide. That ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, when that ratio compresses, when silver outperforms gold, it signals a shift in the monetary risk appetite of the market. If today's press conference sends any signal of sustained uncertainty, of a new Fed regime that's harder to predict, of a communication architecture being deliberately dismantled, silver could begin to price in a new reality. Not because of one press conference, but because regime changes don't announce themselves cleanly. They start with small signals, and traders who understand what they're looking at can position before the crowd figures it out. The bigger picture, the Warsh paradox. Here's the paradox that almost nobody is talking about. Kevin Warsh has been described as a sound money advocate. He believes in monetary discipline. He's criticized the Fed's balance sheet expansion. In theory, a more hawkish, more disciplined Fed should be bearish for gold. And when he was nominated in January, that was the initial reaction. Gold and silver both sold off sharply on the nomination announcement. But here's where the thinking has to go deeper. There's a difference between a central banker who believes in sound money and one who can actually deliver it. Warsh is walking into a situation where the US government is running deficits that require extraordinary financing, where the national debt is at historic levels, where the political pressure from the White House is for rate cuts, not rate hikes, where the global dollar order is under structural pressure from de-dollarization trends among BRICS nations. The constraint isn't ideology, the constraint is math. Even if Warsh wants to be the next Paul Volcker, and there's genuine debate about whether that comparison holds, the fiscal reality of 2026 is fundamentally different from the fiscal reality of 1980. In 1980, Volcker could raise rates to 20% because the national debt was manageable. The interest payments didn't threaten to crowd out every other government function. Today, every percentage point increase in rates adds hundreds of billions of dollars to annual interest payments on a debt that is already at a scale that would have been unimaginable to Volcker. The math doesn't change because the chair changes. And historically, when the math doesn't support the ideology, the math wins. What to watch in the press conference. So here's what I want you to actually watch today at 2:30 p.m. Eastern when Warsh steps to the microphone. First, listen for how he talks about inflation expectations. Does he sound concerned? Dismissive? Warsh has previously called AI structurally disinflationary, meaning he thinks technology will eventually bring inflation down on its own. If he leans on that argument today, it's a signal he's not in a hurry to hike. And that's actually more complex for gold than it sounds. Second, watch what he does or doesn't say about forward guidance. If he explicitly begins to walk back the commitment to regular press conferences, if he signals he will not always communicate after every meeting, that's a structural shift. Markets will need to price in more uncertainty immediately. Third, watch the language around the dot plot itself. If Warsh opts out of his own dot submission, the committee says nothing, and markets have to guess what the new chair actually thinks about rates. That's a new era for Fed communication. And new eras are when smart money repositions before retail investors catch on. Fourth, watch for any comment on the dollar, on global reserve dynamics, on de-dollarization. Warsh knows what's happening globally. He knows that the dollar's share of global reserves has been declining. He knows that China and Russia and a growing coalition of nations are building alternative settlement systems. Whether he addresses that directly or carefully avoids it will tell you something important about how seriously the Fed is taking the structural threat to dollar dominance. The emotional moment, why this matters to you. Let me be direct with you for a moment. I know that for a lot of people watching this channel, this isn't just an investment thesis. It's something more personal. You've watched inflation eat into your savings. You've watched the cost of groceries, rent, energy, and healthcare outpace every interest rate your bank has ever offered you. You've felt the quiet devastation of a currency that keeps buying less and less. And for years, the official message from Washington and the financial media has been, trust the Fed, trust the process. The data is complex. We're managing it carefully. And now, the new Fed chair is walking into his first meeting and signaling that the framework the last Fed chair built, the whole communication architecture, the dot plots, the press conferences, the forward guidance, might be dismantled. Which means the framework you were told to trust is changing. That's not a reason to panic. Panic is never a strategy. But it is a reason to pay attention, to think carefully about what anchors your financial security when the institutional anchors shift. Physical assets have played that role across multiple monetary regimes, across currency crises and central bank transitions and geopolitical realignments. Not because anyone promised they would, but because the math of scarcity and the history of monetary trust tends to favor things that can't be printed. What the smart money is watching. Let's bring this back to the macro picture before we close. Here's the setup as of today. Inflation is at 4.2%, well above target. The Fed is holding rates at 3.5 to 3.75%. Real rates are functionally negative. A new Fed chair is taking over and signaling a communication regime change. At least 3 FOMC members may be projecting hikes, not cuts. The dot plot is expected to remove its last projected cut, formally ending the easing cycle. Energy prices are elevated because of geopolitical conflict. The US deficit is large and growing. Global de-dollarization trends are continuing quietly in the background, and gold is sitting above $4,300 an ounce. Now tell me, does this look like the conditions under which the monetary system is becoming more stable? Or does it look like the beginning of a transition? Because history doesn't ring a bell at the top of an era. It only looks obvious in hindsight. The people who positioned in gold before the dollar left Bretton Woods in 1971 looked early, until they didn't. The people who understood real rates in the stagflation of the late 1970s looked early, until they didn't. If the Warsh era does represent a fundamental shift in how the Fed communicates, and the early signals strongly suggest it does, then the question isn't whether precious metals benefit from that shift. The question is whether you understand it before the crowd does. I'll leave you with this. Every major monetary transition in modern history has been preceded by a period where people argued about whether it was really happening. Was the dollar really leaving gold? Was Volcker really going to hold rates that high? Was the 2008 crisis really that serious? The argument always happens before the transition. The recognition almost always comes after. Right now we are in the argument phase of a potential regime change at the world's most powerful central bank. Warsh steps to the microphone today. He will say measured things, careful things. He will not announce the end of the dot plot or declare that forward guidance is dead. But listen for what's underneath the words. Listen for the beginning of a new era in Fed communication. Because if history is any guide, the beginning of new eras is exactly when the most important positioning decisions get made. Not in the panic, not after the crowd figures it out. Right now, before the transition is obvious. Stay informed, stay positioned, and I'll see you in the next breakdown.